Before we begin, this video is for educational purposes only and is not financial advice. Always do your own research before making any investment decisions. There is one investment mistake so common, so widespread, and so costly that 99% of beginner investors make it without even realizing. It's not picking the wrong stock. It's not investing too little. It's something far more fundamental, and it could be costing you tens of thousands of euros over your lifetime. In this video I'm going to reveal exactly what that mistake is, why almost everyone makes it, and precisely what to do instead. Stay until the end, because this one could change everything. Let's get into it. Picture this. Someone decides they want to start investing. They're motivated, they've done some research, they're ready to take control of their finances. They open an investing app. They look at what's available. And then, overwhelmed by thousands of options, they do what feels logical. They pick something familiar. A company they've heard of. A sector that's been in the news. Crypto because everyone's talking about it. Tesla because it sounds exciting. The latest hot ETF that's been trending on social media. Or alternatively, they do endless research. They read articles, watch videos, compare funds, analyze performance charts. They spend weeks or months trying to find the perfect investment before committing a single euro. Both of these approaches have the same fatal flaw. And that flaw is the one investment mistake 99% of beginners make. Are you ready? Here it is. They try to beat the market. Whether consciously or not, by picking individual stocks, chasing recent winners, timing their entry, or endlessly searching for the best performing fund, most beginners are attempting to outsmart one of the most complex and competitive systems in the world. And the data is absolutely brutal about how that turns out. Let's look at the evidence, because this isn't an opinion. It's one of the most thoroughly researched areas in all of finance. Every year S&P Global publishes a report called the SimpleWealth Scorecard, which tracks how actively managed funds perform versus simple index funds. The results are consistently devastating for active management. Over a one-year period, roughly 60% of actively managed funds underperform simple index funds. Over 5 years it's around 80%. Over 15 years, over 90% of professional fund managers with entire teams of analysts, billions of dollars of resources, and decades of experience fail to beat a simple index fund. Let that sink in. More than 9 out of 10 professional investors, people who do this full-time for a living, cannot consistently beat the market over the long run. So what chance does a beginner investor checking their phone app in the evenings have? The stock market is the most competitive information processing machine in the world. Thousands of professionals, algorithms, and institutions are constantly analyzing every piece of available information and pricing it into stocks instantly. Finding a genuinely undervalued stock, one that the entire market has somehow missed, is extraordinarily difficult even for the best minds in finance. This isn't to say it's impossible. Some investors do beat the market. But the overwhelming majority don't, and more importantly, there's no reliable way to identify in advance who will. Here's where it gets really painful, because trying to beat the market doesn't just fail to generate extra returns. It actively costs you money in multiple ways. The first cost is fees. Actively managed funds charge significantly higher fees than index ETFs, typically 1% to 2% per year versus 0.07% to 0.25% for index ETFs. As we've covered before, that fee difference compounds into tens of thousands of euros of lost wealth over a 30-year investing horizon. The second cost is tax. Every time you sell a winning investment to buy something else, you trigger a capital gains tax event. Active investors who frequently trade in and out of positions accumulate significant tax bills that passive index investors simply don't face. In Germany, capital gains are taxed at 25% plus solidarity surcharge, a meaningful drag on returns for frequent traders. The third cost is behavioral. Active investors tend to buy high, when excitement is at its peak, and sell low, when fear takes over. This buy high sell low cycle is the single most destructive behavioral pattern in investing, and it affects the vast majority of people who try to actively manage their money. The fourth cost is time and stress. Monitoring individual stocks, following company news, analyzing quarterly earnings, active investing demands enormous time and mental energy. Most people dramatically underestimate this cost. The answer is almost embarrassingly simple. And that simplicity is actually why most people resist it, because it feels too easy to be the right answer. Stop trying to beat the market. Own the market instead. A broad global index ETF, like the iShares Core MSCI World or the Vanguard FTSE All World, gives you ownership of roughly 1,500 to 3,700 companies across the entire global economy. You're not betting on one company, one sector, or one country. You own everything. When the global economy grows, which historically it has, consistently, over every long time period, you grow with it. You don't need to research companies. You don't need to monitor news. You don't need to time the market. You set up a monthly savings plan, automate it, and let decades of compound growth do the work. This approach, called passive investing, has consistently outperformed the vast majority of active strategies over long time horizons. Not because passive investors are smarter, but because they stop making the mistakes that cost active investors so dearly: high fees, emotional decisions, tax drag, and the impossible challenge of consistently outsmarting millions of other market participants. The best investment strategy isn't the most complex one. It's the one you can stick to consistently for 20 or 30 years. And nothing beats a simple, low-cost, globally diversified ETF for that. Now let's be honest, there's nuance here. Owning a small amount of individual stocks isn't necessarily wrong. If you genuinely understand a company deeply, believe in its long-term prospects, and can stomach the volatility, allocating 5 to 10% of your portfolio to individual stocks is a reasonable satellite position around your core ETF holdings. What's wrong is making individual stock picking or market timing your primary investment strategy. What's wrong is letting FOMO drive you into the latest hot asset. What's wrong is paying 1.5% per year in fees to an active fund manager who statistically will not beat a simple index ETF over your investment lifetime. The framework is simple. 80 to 90% of your portfolio in one or two broad global ETFs, your core. 10 to 20% maximum in higher risk individual bets if you want to try your hand at stock picking, your satellite. Never let the satellite drive the strategy. Most beginners get this backwards, spending 90% of their attention on the exciting 10% and neglecting the boring 90% that actually builds their wealth. Don't make that mistake. So there it is. The one investment mistake 99% of beginners make, trying to beat the market instead of owning it. The evidence is overwhelming, the costs are real, and the solution is beautifully simple. A low-cost globally diversified ETF, automated monthly contributions, and the patience to leave it alone for decades. That's it. That's the strategy that beats almost everything else over the long run. Subscribe to SimpleWealth for more simple investing content every single week. Drop your questions in the comments, we read every single one. See you in the next one.